The 5-year Treasury started the week at 3.83%, and the 10-year was at 3.95%. Now, the question isn't whether the Fed will cut rates this year, it's when. The futures market is calling for an 81% chance of a cut in March. Want to know the odds of a cut by June? 0. The market's also saying there's a 0% chance that the Fed funds rate will be over 4.5% by year end. Now, whether a cut will happen in March remains to be seen, but it's safe to say that we should see at least one rate cut on or before June. So we're going to get 2 more core PCE reports between now and the March FOMC meeting, which happens on March 20th. Now that the Fed has announced that they'll be cutting, financial conditions have started to ease, short-term rates have dropped, the stock market's rallying, and while I think a rate cut in March would be smart, especially if the Fed wants to achieve the soft landing they've been selling, I think the Fed will likely hold off until closer to June, primarily because I think they want to hold off as long as possible to make absolutely certain that inflation doesn't come roaring back. Remember last year I talked about the Bank Term Funding Program, where the Federal Reserve allowed banks and credit unions to borrow funds for up to 1 year, pledging their U.S. Treasury holdings and agency debt as collateral valued at par. Well, March will also be the expiration of this debt. And unless they extend the program or treasuries drop significantly, mind you, the 10-year was at 3.7% before the collapse of SVB when this program was put together. And about $150 billion in cash will need to be repaid, largely by regional banks and credit unions. So what does this mean? Well, there's definitely cause for concern for the smaller banks, which do a large share of the lending, especially in the commercial space, including multifamily and even owner-user deals. So that means that lending may still be tight for the near-term future, meaning spreads may be higher, LTVs may be lower, and banks will be overall more picky. Of course, we're always on the hunt for the needle in the haystack or that lender that drops their rates to get some business. There are lenders out there. They just aren't as easy to find these days, and financing comes with more compromises than we've grown accustomed to in a low interest rate environment. Also, have you noticed that the yield curve has uninverted recently? The 30-year Treasury is officially higher than the 2-year Treasury. So if you look at a chart showing the yield curve, when the yield curve's uninverted in every cycle dating back to 1989, a recession always follows. We're in that territory now. So now that the 2-year and the 10-year Treasury likely won't be uninverted until the Fed starts cutting rates. Guess how long the average amount of time is between a yield curve inversion and recession? If you guessed 18 months, you would be right. And it's officially been 18 months. So before I let you go, it's officially been 18 months. Cut out this part and then I'll start just the ending because I want to do a second video that will release. So that's it for this week's update. As for this week, it's going to be a little bit quiet. There will be a whole bunch of Fed speeches before this month's FOMC meeting. I think it's on the 31st. So have a great week, everyone. I am going to be putting out another video because there are some new tenant protections that are coming into effect, or some that have already gone into effect this year. So I really want you guys to know about that. This is something that's been top of mind for me. So some things that you need to look out for as landlords if you own multifamily. Have a great week, and I will see you next week.